Hello and welcome everyone to my channel, The Quality Investor. Earnings season has been a roller coaster the last few weeks, and it seems like the market has been punishing hard businesses that miss expectations or, God forbid, lower guidance. This week alone, chip stocks such as ON Semiconductor and Lattice Semiconductor both saw drops of over 15%, and software such as Confluent, Bill Holdings, and Paycom also had gut-wrenching losses. Today, however, I'm going to be discussing Fortinet, ticker FTNT. A couple weeks back, I did a video on their intrinsic value and what I thought would be a good buy price. So this is an update to that video. Arguably, the leading cybersecurity company in the world, Fortinet, saw a dramatic 23% decline when markets opened Friday after releasing seemingly very good earnings. Why? Why is the market hitting Fortinet so hard? Well, Fortinet committed the cardinal sin of lowering their full year 2023 revenue guidance by $120 million. In Q2, management guided revenue in the range of $5.35 billion to $5.45 billion, and in Q3 they revised downward to $5.33 billion. Never mind that they increased guidance for their operating margin by 75 basis points, and they guided their EPS upwards 3 cents to $1.56. However, they also did lower their billings guidance by about $355 million, down to $6.235 billion. So the question becomes, are these lowered expectations worth such a drastic decline? Well, let's get into the details. But first, if you enjoy content like this, please hit that like button and subscribe to the channel. Also, hit the notification bell so you can know right away when I post more stock analysis content. An important point, probably the most important to keep in mind as the owner of a business, is free cash flow. At the end of the day, the thing we care about most is how much money is in our pockets at the end of each month, each quarter, or each year. And we want to see that amount increasing each period. Warren Buffett said, "If you could predict all the cash a business could give between now and Judgment Day, discounted at the proper discount rate, that number is what the intrinsic value of a business is." End quote. The market is basically quoting us a price, $50.48 in this instance. So our question becomes, is the price the market is quoting the actual value of the business? So today, Fortinet had a pretty drastic drop there, 12.35% after opening down at over 20%. And we can see if we switch over to the 5-day chart, just that fall off of a cliff here. So what I want to know is if this drop is justified or if we're on a very good sale for Fortinet. So Fortinet, in part of their earnings release, gave us this handy dandy presentation. And in it, they have the statement of cash flows here. And you can see that their free cash flow, okay, is at $481.1 million. Now that is an increase sequentially, a bit of a decrease from Q1 23, but you can see starting in Q3 21 that they've increased their cash flow nicely up to through today. And that, as shareholders or owners of a business, that's what we want. We want to see that increasing free cash flow. Zooming out a bit to the last 12 months adjusted free cash flow, you can see each quarter they've had a nice steady rise in cash flow. Coming over to their income statement, we can see total revenue both on 3 months ended and year to date, they've had a nice increase. And on the gross profit here, $1.016 billion from $866 million in the previous 3 months ended. That's an increase of 81 basis points, expanding their margins. Coming down to their operating income, we can see that $303 million is a nice increase over the $265 from the prior year quarter. However, that is a very slight decrease in the operating margin, but on a year-to-date basis, they increased their operating margin by 248 basis points. And then looking a little bit at the earnings per share here, 41 cents versus 29 cents year over year. That's an increase of 41.4%. So Fortinet is definitely delivering both top and bottom line growth. On to the balance sheet now. So one thing I wanted to point out here was if you take the current liabilities section, the deferred revenue in that section, $2.6 billion, add that to the deferred revenue in the long-term liabilities of about another $2.6 billion, that's $5.285 billion in deferred revenues. Now that is a 13.9% year over year increase from 2022. And deferred revenues are essentially billings that are not yet recognized as revenue in the current period. So as those billings become recognizable, they will move to the revenue section of the income statement. We can also see that they're building up cash, 2.1 billion versus 1.6 billion at December 31st, 2022. And that 2.186 billion in cash is over double the amount of long-term debt they have. Meaning, for every $2.20 of cash that they have $1 of debt. So they're more than capable of covering their liabilities, and they have a very strong balance sheet. Another slide I found interesting in their earnings presentation is the number of deals, and particularly number of deals greater than 1 million. You can see they've had a nice steady increase since Q3 2021, and they now have in Q3 23 over 145 million deals closed in Q3 23 of over $1 million. So they're growing at every phase of the business, and they have a very strong balance sheet. However, markets are forward looking. So what are they actually projecting going forward for their various segments? Well, they have a slide here. It's called the large and growing total addressable market. And each of the three reporting segments, secure networking, security operations, and universal SASE, they're projecting nice, strong growth through 2027. So currently they say the total addressable market's 125 billion, and they think that's going to grow to nearly 200 billion by 2027. And that's 9% for their secure networking, and then 14% for security operations, and 20% compound annual growth rate for universal SASE. However, while that growth is very good, the key important takeaways from this is that Fortinet is shifting its R&D and go-to-market investments to the faster growing SASE and SecOps segments. And they mentioned that on their earnings call. So they said that with execution and continued investment in SASE and SecOps markets, Fortinet believes it could return to mid to high teens top line growth while continuing delivering operating margins of 25% or greater. Okay, so now I want to focus on what I believe is the actual intrinsic value of Fortinet. In my original video, I said that the acceptable buy price was $58.41. And at that time, it was a wait for me. They were trading right around $59, $60. And I did have a valuation average of $73.01. So there was pretty good upside there. But personally, I was looking for a 20% margin of safety just due to how disruptive the software market is. It's also important to note at that time, the trailing 12 PE was at 44.7 and their forward PE was at 40.5 for Fortinet. So now we're back on my current valuation for Fortinet, and I just want to point out some charts here. I'm not going to go through the whole valuation, but just look at the revenue, gross profit, and net income growth of the last 40 quarters, basically. I mean, this is it's incredible, staggering growth, and this is exactly what we want to see out of a very good quality business. They also do a great job of lowering their SG&A margin and their operating expense margin. They've also had a great increase in their earnings per share, and their share outstanding, they have some fits of, share issuances, but they're also buying back shares. Looking at their balance sheet charts there, and this is where they really stand out to me. So the free cash flow, again, the most important thing we as owners care about, look at that increase over the last 40 quarters. That is exactly what we want to see, a business growing the cash available to owners. And they've also increased the cash on the books as well. So they're definitely having a nice cash buildup. They're not burning through cash. The only real downside I have on their balance sheet is they do have debt. However, it's not a crazy amount of debt. And like I said before, they have over $2 of cash for every dollar of debt. So this sheet here is showing my latest projections after the most recent earnings release. And a couple things I want to point out is they delivered a year-over-year revenue growth of 16%. My original estimate for this quarter was 15%. And they also had a free cash flow margin of 36%. And my original estimate was at 20%. So they beat expectations on Wall Street, but they also blew away my own analysis. And personally, I like to keep things more conservative just so I'm not hurting myself in the valuation. And a couple other points here. I lowered my expectations here to match the management guidance. So this is actually the low end of their guidance, each of the Q4, the December 23 numbers here. And I kept my growth rates for revenue going forward for years 2 through 6 and then 6 through 10. I kept the exact same as what I had in the previous valuation. I also am estimating a 25% operating margin per what the management stated, what their projected growth is through 2027. And crucially, I kept my free cash flow margin percent estimate here at 35.5%. That's exactly what I was projecting in the previous valuation. So I didn't increase my expectations there. And I think it's very reasonable to expect that a free cash flow margin can grow. In fact, it's not growing, it's shrinking. 36% in the end of 2023 to 35.5%. Really, they could grow that. This is being very conservative in my opinion. If you look at, that's a 0.79 compound annual growth rate over the next 10 years, which does match what their previous 10 years was as well. But that 10.95% growth rate in free cash flow in general over the next 10 years is half of what their historical 10-year growth rate was. So keep that in mind. If they essentially keep their free cash flow margin at what it is today, and they grow their free cash flow in total by half of what they grew in the last 10 years, what then is the share price that we come to after we discount all these cash flows? So after updating for the most recent quarter and based on the lower end of the management guidance, I get a discounted cash flow of $75.75, which is actually about 90 cents higher than what my original estimate was. And the exit price, however, is at $68.54, which is about $1.40 less than my previous estimate. However, that gives us a valuation average here of $43.22. And like I said, I'm keeping that 20% margin of safety here. That now gives us an acceptable buy price of $58.58, which is basically the same as what it was before. So with that nice little decline today in the markets, we have more than enough of an acceptable buy price for Fortinet. And I also mentioned those PE ratios in the original video there. So now we're at a 34.8 trailing 12 PE for Fortinet and a forward PE of 30.9, both of them well below their 5 and 10-year averages. So in my view, Fortinet is now a very nice undervalued business. So in my opinion, Fortinet delivered a very strong quarter and they have very healthy financial statements. So what happened today in the markets, in my view, is a gross overreaction. But before we go, I do want to remind everyone that this is not financial advice and I do not own a stake in Fortinet. And with that, thank you for watching today's video. And what do you think? I love the feedback, so please comment below with your thoughts. Finally, please hit that like button. And if you found this info helpful, subscribe to the channel. Thank you and happy investing.